Hi, today I'll be discussing the Federal Reserve System of the United States of America. The United States banking system is quite complex and involves several parts working together to ensure the stability of the economy. One of those key resources is the Federal Reserve System. What is the Federal Reserve System? The Federal Reserve System, per definition, is the United States federal banking system that is under the control of the Central Board of Governors, with a central bank in each of the 12 districts, and has a wide power of controlling credit and the flow of money, as well as in performing other functions in regulating and supervising in each bank. Overview of the Federal Reserve. During the 19th century and the beginning of the 20th century, financial panic plagued the United States, leading to bank failures and business bankruptcies that severely disrupted the economy. The failure of the nation's banking system to effectively provide funding to these troubled depository institutions contributed significantly to the economy's vulnerability and financial panics. Short-term credit is an important source of liquidity when a bank experiences unexpected and widespread withdrawals during a financial panic. Banks during this period experience what is known as a bank run, which is when most of the depositors withdraw their money and the bank doesn't have the cash to meet the deposits. After several of these banking panics, Congress passed the Federal Reserve Act on December 23, 1913. Originally, the Federal Reserve was instituted to provide lending during poor economic times, but over the period, Congress has broadened the role to the Federal Reserve through legislation. Today, the Federal Reserve's duties fall into four general areas: conducting the nation's monetary policy by influencing the monetary and credit conditions in the economies in pursuit of the maximum employment, stable prices, moderate long-term interest rates, supervising and regulating banking institutions to ensure the safety and soundness of the nation's banking and financial system, and to protect the credit rights of consumers. Also maintaining the stability of the financial system and containing the systematic risk that may arise in financial markets, providing financial services to depository institutions, the United States government, and foreign official institutions, including playing a major role in operating the nation's payment system. Congress designed the structure of the Federal Reserve System to give it a broad perspective of the economy and on economic activities in all parts of the nation. It is a federal system composed of a central governmental agency, the Board of Governors in Washington, D.C., the 12 regional banks, Federal Reserve banks. The board and the Federal Reserve share responsibilities for supervising and regulating certain financial institutions and activities, and for providing bank services to depository institutions and the federal government, and for ensuring the consumer receive adequate information and fair treatment in their businesses with the banking system. A major component of the Federal Reserve System is the Federal Open Market Committee, which is made up of members of the Board of Governors, the president of the Federal Reserve Bank of New York, the president of the four other reserve banks, and the board president. The FOMC oversees open market operations, which is the main tool used by the Federal Reserve to influence overall monetary and credit conditions. The Federal Reserve implements monetary policy through its control over the federal fund rate, the rate at which depository institutions trade balances at the Federal Reserve. It exercises its control by influencing the demand for and supply of these balances through following means. Structure in the Federal Reserve continued. A network of 12 Federal Reserve banks and their branches carry out a variety of system functions, including operating a nationwide payment system, distributing the nation's currency and coin, supervising and regulating member banks and holding companies, and serving as bankers for the United States Treasury. The 12 reserve banks are all each responsible for a particular geographic area and district of the United States. Each reserve district is identified by a number and letter. Besides carrying out functions for the system as a whole, such as administrating nationwide banking and credit policies, each reserve bank acts as a depository for the banks in its own district and fulfills other district responsibilities. Structures of the Federal Reserve continued. The Board of Governors of the Federal Reserve System is a federal government agency. The board is composed of 7 members who are appointed by the President of the United States and confirmed by the United States Senate. A full term of a board member is 14 years, and the appointments are staggered so that when one term expires on January 31st of each even-numbered year. After serving a full term, a board member may not be reappointed. If a member leaves the board before his or her term expires, however, the person appointed may be confirmed to serve the remainder of the term, may later be reappointed to the full term. The chairman and the vice chairman of the board are also appointed by the president and confirmed by the Senate. The nominees to these posts must already be members of the board or must be simultaneously appointed to the board. The terms for these positions are 4 years. The Board of Governors is supported by staff in Washington, D.C., numbering about 1,800 as of 2004. The board's responsibility require thorough analysis of domestic and international financial and economic development. The board carries out these responsibilities in conjunction with other components set by the First Federal Reserve. Chairman of the board. The chairman of the Board of Governors of the Federal Reserve System is a very, very top of the Federal Reserve System. The chairman directs monetary policy, determines the course of the Federal Reserve activities. When the chairman speaks, business leaders and politicians and leaders take notice. The chairman is appointed for a 4-year term by the president, subject to confirmation by the Senate. However, unlike other presidential appointees, such as the Secretary of State and Secretary of Defense, the Fed chairman is selected for as much as the effective stewardship of the economy as for political philosophy. Major component of the system is the Federal Open Market Committee, which is made up of members of the Board of Governors, the President of the Federal Reserve Bank of New York, and President of the 4 other reserve banks. The Federal Reserve System uses the FOMC to conduct 4 major policies: the open market operations, which is the purchase and sale of securities, primarily U.S. Treasury securities. Also, the reserve requirement, which is a requirement regarding the percentage of certain deposits that depositories and institutions must hold in reserve in the form of cash or an account at the Federal Reserve. Contractual clearing balances, an amount that the depository institution agrees that they must hold at the Federal Reserve Bank in addition to any required reserve balance. And lastly, the discount window of lending, which is an extension of credit to depository institutions made through primary, secondary, and seasonal lending programs. The Federal Reserve System is a pivotal component of our economy. Without the monetary functions of the Federal Reserve, the economy indefinitely of the Board of Governors overseeing critical financial instruments like credit and interest rates.